And I think as we take a look at entering 2026, the momentum is actually fairly strong. This is an environment where there are a lot of risks that we have to watch. But when we look at what's actually happening, that's really where we think the rubber meets the road and gives us that optimistic view. We are seeing that in the inflation data, we're seeing that in corporate earnings data, but they're doing it as they need to, right? And as they have to. And so it's leaked its way into the system rather than being a sudden one-time shock.
Hey there, everyone. Dave Keller here with Market Misbehavior, and welcome to our latest episode of the Market Misbehavior podcast. A good discussion to share with you today with Rob Haworth. Rob's with U.S. Bank Asset Management, based here in Seattle, Washington. Good discussion about all things macro. We went from economic conditions to the Fed and Fed policy to geopolitical events, midterm election years, and how to think about those within the context of all of those macro conditions, and so much more. Good discussion, just taking assessment of current market conditions as measured through economic data, but relating the economic data to market conditions. Really good points along those lines, and I hope you find that valuable. So please enjoy this conversation with Rob Haworth of U.S. Bank Asset Management. Super excited to be sitting down today with Rob Haworth of U.S. Bank Asset Management. Rob, you and I were talking before. I don't have a lot of Seattle interviewees, so as a Pacific Northwesterner, awesome to have you on the show. Thanks for coming on.
Yeah, fantastic to be here, and great win for us on Sunday. So it's been a great week here in Seattle.
I did have the Seahawks full branding behind me for a couple days, and then it just felt inappropriate at some point, so I had to take it down. But yes, let's celebrate the great win. The parade was right downtown yesterday, so that was fun. Market conditions continue, I guess, to be fascinatingly confusing in 2026 is the way I would think of it. But I'm very keen to get your observations. A lot to talk about, and certainly just this week we're starting to see quite a bit of fluctuations, particularly in large cap growth. And so I'd love to talk about that as well. If we could, start us at a high level, Rob, for those that aren't as familiar with your work, thinking about like macroeconomic conditions, big picture, how do you kind of approach the markets? What are the things, kind of the main areas that you are evaluating when you're trying to assess conditions here today?
Yeah, as we think about it, we are really trying to understand where is this economy headed? What is happening when it comes to inflation? What are the policy factors that are maybe driving us, both fiscal and monetary? And then what are asset class trends telling us, right? Trends remain an important factor in telling us a bit about the story about how the market is interpreting all these fundamental factors. And I think as we take a look at entering 2026, the momentum is actually fairly strong. And even though, right, I think if we think about the first 6 weeks of the year, it's been a little more challenging, particularly if you've been a technology or AI focused investor. The underlying trends are still strong. The momentum for the economy is strong. And that's really what underpins our understanding about the future and underpins our view that we should be tilting towards risk assets at this point and away maybe from high quality fixed income, just because we think there's more opportunity here, right? But those are the factors we kind of look at just to make sure that we're grounded in fundamentals and then leaning on what are we learning from prices in the market that tell us something about the forward view.
So with things like the economic conditions, I feel like for a while now, it's almost like a tale of two markets. I feel like it's not hard for me to find people that argue that the economy is strong and it's great and look how great things are. But then on the other side, it's not hard to find people that say this doomsday scenario is just around the corner because of X, Y, Z. As much of an unbiased view as you can provide, what would be your answer to that question in terms of is the economy as strong as some people think, or is it as bad as some people fear, or somewhere in the middle?
We like to take the middle road almost all the time, but I think this is an environment where there are a lot of risks that we have to watch. But when we look at what's actually happening, that's really where we think the rubber meets the road and gives us that optimistic view. A great example for us is the consumer, right? The consumer comprises 69, 70, 71% of the US of GDP growth, right? It is the driver of this economy. And if we look at consumer confidence data, whether it's from the Conference Board or University of Michigan, the news doesn't look great. We look like a very frustrated society that is going to stop spending. But when we look at retail sales data, December's data accepted, but if we look at, say, weekly retail sales over time or the full year, consumers are still spending money. Not only that, they have jobs. Weekly jobless claims came in at about 227,000. We're in a very low environment for weekly jobless claims. So people have jobs. When people have jobs, they tend to spend money. When they become concerned is when they don't have jobs and they really pull back and stop spending money. So I think for us, we're looking more for what are people doing than what are people saying. And that's the key for us as we get constructive on this economy is what people are doing is spending money. And that's true in businesses as well, right? Artificial intelligence capital expenditures, if we look at the big six firms that are out there, right, they're taking capital spending on artificial intelligence up 60% in 2026 over 2025 based on what they told us from earnings. So what people are doing is really the constructive thing that makes us constructive on the economy and the markets. Still concerns, right? There are still concerns we have to have about this, right? There can be significant changes in the geopolitical landscape, right? We've seen some uncertainty already this year as we had questions about what is the resolution going to be in Greenland? How long are we going to be dealing with Venezuela? What's really happening between the U.S. and Iran, right? Is there going to be more strife, more conflict that broadens out? Are we going to get a settlement in Russia, Ukraine, right? All of those things can derail this economy a little bit in the near term, but they haven't yet. I think the second thing we have to watch and be worried about is, do we see tariffs start to ratchet higher again? The market has settled into a pretty good place that it can deal with, call it mid-teens tariffs, right? That seems to be where the Yale Budget Lab is settling out. The market's gotten very comfortable with that. If we see tariff rates really ratchet higher, right, that's another leg we need to put on inflation, not permanently, but temporarily. More price changes for us, and maybe more of a challenge for the market in the near term, as we saw in April last year. So I think there are lots of worries out there for us, but until those are things that actually happen, this is a market that has enough momentum behind it and enough things that are happening constructively to drive it higher.
I mean, there's so many good points in there, Rob, that I'd love to tease out. I mean, you brought up tariffs in particular. When we sort of had the tariff tantrum period now almost a year ago. The sort of potential paths that were laid out were very different, right? I mean, tariffs are going to be the end of the world. Consumer inflation is going to be sky high. It's going to be a disaster. Too, it's going to be a non-issue. I'm curious, have you been surprised by what the tariff policy, and obviously it's been a pretty volatile policy, path, but has the impact or arguably the lack of impact on tariffs in terms of keeping down this resilient bull market, has that surprised you in terms of that disconnect between what felt like it could be a challenging policy, but then the reality was pretty minimal, I would say generally, right?
Yeah, I think two things were constructive and surprising for the market. One, the president backed off fairly quickly, right? I mean, literally, it was 7 days between Liberation Day, right, April 2nd, and when we got the market bottom, right? It was very quick, where the president pivoted and the market said, okay, it's not going to the moon, right? Tariffs are going to be something we can deal with, and there will be changes here in negotiations. And we've seen negotiated tariff rates come in fast and furious and come in that 15% range, right? So that's, I think, surprising thing one is the pivot, which really allowed the market to get its arms around it. And then the second surprising thing has been how companies reacted. Companies have been passing along tariffs. We are seeing that in the inflation data. We're seeing that in corporate earnings data, but they're doing it as they need to, right? And as they have to. And so it's leaked its way into the system rather than being a sudden one-time shock to the system. And so I think that's been constructive. And I'd add a third thing. The third thing that's been so constructive is really the labor market. Now, not great, right? Not a great story of robust labor growth last year, of robust hiring last year, but good enough that people have jobs and wage growth that they're able to absorb these tariff impacts at these levels and continue to spend. Now, they're having to make choices. We heard that about the holiday season, where people maybe went for higher quality, more unique experiences as opposed to lots of basic goods.
Mm.
Um, uh, but yeah, right. We've been able to really adapt to that. Now, there's a question I think as we roll forward, can that continue? And that's certainly a risk we look at. If something changes significantly in the labor market, if something changes significantly for inflation with valuations as elevated as they are in U.S. markets, yes, we may have a period of adjustment. But for now, right, I think as we look back at tariffs, we were really given a bit of a reprieve in that they weren't as high as people feared. Companies were able to work those into their cost increases through time. In the labor market, people stayed employed and had wage growth that allowed them to adapt to those higher costs.
Oh no, that's well said. And again, I feel like that initial reaction many had to tariffs, and I certainly was guilty of that as well. It was so easy to think about all the negative ripple effects, but you're right. A number of things have evolved. It's been a number of months now, almost a year, and we've seen a lot of adaptation as a result. I think that's very well put, Rob. You'd mentioned geopolitical events, and obviously we're in a midterm election year. Those that know sort of the 4-year presidential cycle of markets, this is usually the weakest of the four. This is when things get a little squirrely because you often have a president that might be doing some unpopular things. There's a vote of confidence in what's going on. How are you thinking specifically about that midterm election season? What is that? How should investors be, sort of preparing today for what we could be expecting later? And how do you sort of weigh in the odds of different outcomes at this point?
Yeah, we haven't started to think about election outcomes too much yet,
Okay.
just because we're fairly early, right? We know typically the incumbent party loses some seats, kind of historically, um, but we'll have to see, right? The president has really gotten a lot of his agenda done already with the One Big Beautiful Bill Act, right? That omnibus spending bill. There's clearly a lot of debate in Congress as to what to do, and executive power has been a feature for the president's first year, right? And has
Yeah.
used that extensively. So a change in Congress maybe doesn't matter as much. Our work on midterm elections, we've done some statistical analysis, and yes, the average return tends to be lower. But what we find is if we try and apply some statistical analysis to it, it's inside that range of normal, right? And that's
Mm.
so as we look at it, what we think really matters for a midterm election year is still the economy, not not political uncertainty. And so that's what we're going to look to fairly hard is what's happening with the economy, what's happening with earnings growth. That's going to be the driver for markets and the meaningful driver for markets. And so, yes, the average return tends to be lower, but when we look at it, it's tough to say that that average return is different from all the other averages, right? And
Mm.
especially then we look at some of the outliers, some of the tails of that midterm election distribution, and they're often explained by economic events more
Mm.
than midterm election events, right? You get surprise Fed rate hikes, you get an inflation spike, you get right a few other things like that that all of a sudden you have these large negative numbers that start to draw that number down. And is that because it's a midterm year or because the economy changed, right? We'd argue it's the
Yeah.
economy. Right? It's in the end, it's the economy. So as we look at it, right, it kind of the table right in front of us. Part of what gets us constructive about this is we already have stimulus coming, right? We're in tax filing season.
Yeah.
The consumer benefits from the One Big Beautiful Bill Act are arriving now, right? If you are tipped, right, that tax benefit from tips is going to show up as a tax refund this year. If you're getting Social Security, that tax benefit of lower tax, no tax on Social Security benefits, that's going to show up at tax refund time, right? That's about $127 billion that's showing up for consumers in the first half of the year. And then you move into summer, and around the country, we will have around actually the region. We have the World Cup. World Cup is meaningful spending for a consumer-driven economy. Whether it's Seattle, Vancouver, right, New Jersey, right, that's meaningful stimulus into the U.S. economy for the World Cup. And then we have the 250th anniversary celebration for the U.S. coming up in the summer. Again, more new spending, right? So as we look at it, right, what we're trying to pay attention to is, you know what, there's a lot that can really lift us here as long as things don't go off the rails when it comes to the labor market, more contraction there, right? There's a lot lifting us into midterms, and then let's see what happens Because, right, as we know, we've had two government shutdowns now in the last 3 months, right? We were shut down for the month of November month of October into November. We just finished our 4-day shutdown, which delayed the jobs report to Wednesday this week from Friday last week. And we've got, one more bill to kind of finish. We won't have a full shutdown again, but that still queues us up for September 30th when the fiscal year ends and all this spending ends. And so we're back around to where we were right ahead of midterm elections, where we have risk of another government shutdown because we know the margins are so narrow in Congress, and it is
Yeah.
tough to get them all to agree. So there's some risks, but they're different from midterm elections, right? And there's some opportunities, right? There's some upside, stimulus in the pipeline, more spending, maybe some Fed rate cuts, which could help us. So it's kind of an interesting year as we think about midterms, but it's really being driven by the economy.
Rob, so many good points in there. The whole issue of ticket prices for the World Cup here in Seattle and around North America, a subject of a whole other podcast. Maybe you and I can do at a future date. For those of us thinking of taking our 10-year-old sons to a match here and there, it's like a second mortgage at this point. But I think your point about balancing, sort of that traditional cycle, right? We think about what usually happens in a midterm election. It's usually an average, and anytime you dig into actual market data, we have that fat tail effect, right? Where things that are,
Yeah.
would not normally be expected to happen very often, happen way more often than a normal distribution would anticipate. That's something I think that catches a lot of individual investors off guard, just the extreme one-off events that happen way more often than you might expect. You had alluded to the Fed, and certainly we had, a Fed that was in full rate cut mode and then sort of in, pause mode. And now the question is, into 2026, what's that future path look like? We had this, and so a two-part question. Number one, we had the government shutdown. All of a sudden, we had a bunch of normal economic data completely interrupted. So we had this kind of gap for a while. And I'm curious for you, as a practitioner who's gauging economic strength, what was the actual impact for your ability to understand things like jobs and inflation when that fire hose was turned off and then kind of, sporadically turned back on? I feel like we're still kind of getting through that. So I'm curious what the impact actually was for you. And then the second thing is, what do you think about with the Fed in the coming months? What is your anticipated kind of path of rate cuts from here?
Yeah, the loss of economic data was certainly interesting, and what was interesting about it for us is we learned a lot during the pandemic. During the pandemic, we saw we really needed high frequency data because the government data didn't arrive fast enough. And so when the government shut down in October and we lost all that important government data, we were able to pivot back to our pandemic playbook and start picking up those privately distributed higher frequency indicators to try and look through, okay, well, what's really happening with the economy, right? Can we get a real-time read of what's happening with consumer spending? So weekly retail sales, right? We could look back at open table seating reservations again. We could look back at theater ticket sales. We could we could look at air travel, right? Are consumers active in spending? So we really went back to a playbook to make sure that we could stay up to date, because ultimately we are managing money for clients every day and need to make those decisions for them every day. And we as investors are all making decisions about how do we price an asset, whether the government publishes data or not, right? We have to do it. Has to happen every day. And so those indicators became important to us again. Interestingly, right, even the weekly jobless claims data, which the Department of Labor, the Bureau of Labor Statistics consolidates from state unemployment claims reports, right? Well, all 50 states, actually 53 regions, continued to publish those jobless claims report while the federal government was shut down. So all that had to happen was we just had to go and pull all those back together to understand, well, what's really happening. So there were places we looked and we kept looking and we had to keep making decisions, and we did make decisions as we worked through the shutdown. So the challenging thing is, and I feel for the government agencies, it is a lot to catch up. Monday this week, we got the retail sales report from the Census Bureau, but that was just for December, right? We're well into February. We should be very close to getting the January report. We're only now catching up to December. There are other, it's just taking a long time to catch back up. And we can see that a 4-day shutdown still delayed by 3 business days, the jobs report. So the agencies are all still catching up and somewhat sensitive to these shutdowns. So we'll be glad to have the granddaddy of data when it gets here. But in the short term, if we have to make other decisions, we will, because we do get some very good indicators elsewhere. And we think that was true for the Fed as well, right? The Fed still had meetings. Fed still had to make decisions in December without all the data they may have wanted to have, right? The pinnacle of their inflation data is personal consumption expenditure deflator, right? They weren't getting that. That's still catching up, right? We're not yet all the way caught up on that data series. And they'll make this, they made the decision to not make a change in January. They'll make another decision here in March, and maybe they'll finally be caught up to data. Maybe they won't. We'll all keep doing that. I think the thing we heard in December for the Fed, and we saw it in January as well, is they're on hold because they're uncertain. And I don't mean that to mean they're not decisive. I rather mean it that across the 17 members, the views are about as broad as we've seen. There are many who for 2026 in the dot plot in December highlighted that they wanted to see 4 quarter point cuts. Some people said we don't need to see any, right? We don't think in 2026 we'll see any cuts whatsoever. That's a fairly wide dispersion for a committee that has to vote and end up in one place with one decision. And I think that's what we're seeing right now is the committee's really not sure, and that's why they're absorbing incoming data. And certainly, you're right, the chair will be important. And we saw significant disparate data even this week, right? Retail sales for December were flat, no change. That makes you worried a bit. But when we look at the January employment report, up by 130,000 jobs. That's pretty good. When we'd averaged 15,000 jobs a month for all of 2025. So if I'm sitting on the Federal Reserve, which one do I believe? And Friday we're going to get inflation, and I'm going to look at that hard as well, because I'm certainly concerned that inflation's been elevated, and for the last couple of weeks we've seen oil prices tick a little bit higher. So is inflation back out there, right? That's the Fed's got to make sure we've got people have jobs, and that was a concern in the back half of 2025 and why they cut rates. They're maybe somewhat less concerned about that at this point. Is inflation going to be a problem? Does that keep them on hold, or is inflation easing? And there's certainly room to see that as well. So I think this is a Fed that wants to see more data, that has room to wait to make cuts. Our base right now, best guess would be we get a couple of cuts over the course of 2026. Those probably are back-end loaded. There's some expectation that President Trump's nominee, assuming Kevin Warsh actually makes it all the way through the process, is biased towards cutting rates, and will obviously have a committee that is widely dispersed in terms of opinions to convince that that's the case to make as we get further ahead. But there's, for us, I think we can wait and see a little more data to really get an understanding of where could the Fed go. The base case, right, and market prices are telling us a couple of quarter point cuts this year may be enough. And keep in mind, we still have those 3 quarter point rate cuts from last year working their way through the financial system. And we've moved from allowing the balance sheet running to run off to back to not really quantitative easing, but to increasing the balance sheet, increasing liquidity in the system. So we're on an easier path for the Fed that should help the financial system as we press ahead as well.
No, really good comments in there, and again, I love that description, the Fed on hold, just because they're uncertain, and the data. I mean, there are so many charts. I mean, my process involves looking at a lot of charts at a lot of things. There are a lot of things sort of in wait and see mode, I would say, right? It's sort of with the S&P and NASDAQ as a key example, sort of chopping around and not really gaining a lot of ground to the upside, not really losing a lot of ground on the downside. Sort of like feels like the entire market sort of holding its breath here, plugging its nose, however you want to think about it, for at least a little bit of time. In terms of changes that we've observed from the, sort of fourth quarter of last year to now the first quarter of 2026 in terms of market conditions, some things remain fairly consistent. For example, like the S&P still kind of generally drifting higher, although albeit at a slower pace here. But there have been some significant changes to think about. The weakness in the U.S. dollar comes to mind, and just a rollover there. Crude oil prices, as you mentioned, starting to rotate higher. That's been one of the most consistent sort of downtrends, now starting to pop higher. Are there any big changes in terms of market conditions that you've observed that investors should be thinking about and aware of as they try to just assess this period here?
Yeah, I think for us, we've seen rotation under the surface when it comes to the markets rather than at the top, right? I think
Yeah.
some of the choppiness you're describing at the top of the S&P 500 can be explained by a couple of things. So, one, we're seeing smaller companies do better. So if you look at, say, the equal weight S&P 500, from a relative perspective, that's starting to beat the S&P 500. So that tells you small companies are doing better. Two, we're seeing some rotation in terms of stronger performance. We're seeing cyclicals start to do better.
Mm.
Energy, last couple of days with rates coming down, we've seen even defensive companies like utilities and real estate start to do a little better. So we're seeing some of that rotation in the market, which we think is constructive. And the reason we think it's constructive is a broader market tends to be a stronger market. It tells you the
Mm.
economy as a whole is getting better, not just one sector, right? We've been so narrowly led by artificial intelligence names, 23, 24, part of 2025. And in the back part of 2025, we started to see this rotation happen. It's continued into 2026. I think the second thing we'd point out is foreign stocks, whether it's
Mm.
developed foreign, emerging markets, very strong performance in 2025, not just driven by a weaker dollar, but actually stronger performance in local currency terms for those markets. We see that continuing as we get into the new year because we talked about strong growth, strong economic growth in the U.S. We're not the only one improving. And one example I'd give of data for that would be global purchasing manager surveys, which just came out for January.
Mm.
All ticked higher, particularly for manufacturing for the world, right? And not everyone is in expansion at this point, but it is that inflection point of improving trends. And so what was solid performance for foreign stocks in 2025, that probably continues into 2026, particularly as we see cyclical names start to do better, which have much heavier weights in foreign indices than here in the U.S., where the largest sector in the U.S. index tends to still be technology, communication services, much less other sectors. Those industrial names, those cyclical names, tend to be much higher weights in those foreign indices.
Really good points. Yeah, we're about 35 or so percent in technology in the S&P at this point, and there are very few global indexes that have that sort of weight in the growth space. So points well taken, and in the small cap space as well, right? You get a much lower weight in technology and other areas of the market that are really providing some opportunities there as well. One asset class you didn't mention particularly, but I'm curious because precious metals, gold and silver, both, I mean, dramatically outperformed the S&P and the Nasdaq in 2025. It's been a choppy 2026, I would say, so far, and they're becoming, they're moving aggressively to the upside, to the downside today as equities are kind of rolling over as well. What gives you the confidence or lack of confidence of continued upward trends in areas like precious metals, which have already had such a run? So I know a lot of investors are nervous about chasing something that's already gained a lot. How do you think about that now? How should investors think about precious metals as part of a broader asset allocation?
Yeah, and we can talk about a couple, but let's start with gold. So up
Mhm.
60% last year. We saw significant central bank purchases for gold in 24, 23, some more in 25. I think that rally in gold was really driven by increasing central bank demand and speculation, less so by fundamentals. If we think about fundamentals that typically correlate to stronger gold prices, lower real interest rates, higher inflation, weaker US dollar, right? And you think about the back half of 2025, you had very strong gold and flat US dollar. So the
Mm.
fundamentals weren't really what was driving it. It was demand, right? It was outright demand. So to get another surge in 2026, I think the question is, do global central banks add another slug of gold to their portfolios? I don't have an edge on that. I don't know if someone has a phone number at the People's Bank of China to know what they're going to be buying. But right, that it's we just don't have an edge on that, so that's tough for us to say fundamentally this is going to happen
Yeah.
because we just don't know. Additionally, what happens when we see volatility spikes like this is you typically need the market to settle out and find a fundamental bottom. So if we believe there's a positive fundamental story to gold, let's pretend we do, that it's not just a speculative fur. You need time for that bottom to be found, right? For prices to kind of sell out, for the weaker speculative hands to be shaken out of their position. Because if we think about, say, ETF flows, we had very strong ETF flows in the month of January up until we got to the peak, and that means all those ETF holders are essentially have not made any money in what
Yeah.
in 2025 was a very strong asset. So we kind of need to see that settle out. From there, yes, we can see further gains for gold, but it does hinge on more people wanting it rather than kind of the fundamental factors we highlight: weaker dollar, lower real interest rates, because it doesn't seem like we're getting lower real interest rates, much higher inflation, right? Those aren't working for it. It is more people have to want it and need it. I'm not sure that's the case. Silver's maybe a little different uh, in that we do have some supply shortages in the futures market, Shanghai in particularly because silver is such an important industrial input for electrification of a
Mm.
grid, of a data center, of an electric vehicle, right? And we are seeing a relatively undersupplied market like we are in copper. That's some of the fundamental demand now at $100 an ounce. And I have to admit I haven't looked at silver today. Um, but even in the well above the previous all-time high of $50 an ounce, I think there's a question of do people start to look for industrial substitutes? And that's one of the interesting things about the silver market is you don't see global central banks buying silver. That was really ETF demand was the marginal demand in 25. And unlike gold, that speculative demand is small in the silver market. It's been around 15%. It's up to about 22%. Really, it's industrial demand. And the challenge is if industrial demand drops off, that's going to be probably more harmful to the silver market because
Mm.
industrial demand is really, by and large, the driving factor for silver. It's not a factor for gold, really. It's store of value jewelry, right? Is how gold really operates. So, I think this is a time where once we see volatility like that, the market is just somewhat exhausted and technically needs to rest. Uh,
Mm.
and then we can see where fundamentals start to sort themselves out, and can fundamentals really drive them higher?
That's awesome. One final question, Robin. I can't tell you how much I appreciate you answering all these questions patiently and thoroughly. Um, you mentioned a number of things about conditions that are looking quite good, right? And when you look at jobs data, when you look at general economic conditions, state of the consumer, not bad, and a lot to be optimistic about. When you are looking around you and assessing risks, we have a situation where same thing, credit spreads pretty narrow still. What's the biggest area of risk, or when you're perceiving potential risk to this sort of good condition we're experiencing in Q1? What stands out to you as an area where you think is most likely to present an issue, and what would you be using? What tools or techniques would be using to validate that as a real risk that manifests itself?
Yeah, I think the one risk is really coming from elevated U.S. valuations, and
Hmm.
to us, that's not a catalyst to make a change, but rather we get worried about that if or when interest rates spike significantly higher. So, say the 10-year Treasury starts to reach back out to 5% because people don't trust that we're going to solve our fiscal house, or there's a flight away from us at something like that, or there's an inflationary spike, right? And so somewhere between inflation and interest rates spiking, which starts to impact investor sentiment, right, means U.S. assets are perched a bit on a risk, on peak risk at 25 times earnings, right, looking
Yeah.
forward on the S&P 500. So I think that's our primary worry: is does something get unlocked in that Treasury market that hurts the equity market? But for now, right? I mean, this is the interesting thing. We've talked about rich valuations for a couple of years now. So what we know is valuations can stay at these levels for a while, particularly when you're seeing such spectacular earnings growth, right? Consensus expectations for the S&P 500 are for around 13% earnings growth in 2026. Now, that's not going to be a spectacular returning year for all of 2026, but it will be a very solid year if we just get the earnings growth on the S&P 500. And so there's room, right? This is why we keep watching around the corners for the risks, but we know the market can kind of tolerate them until they come to fruition. And that's where, for us, watching that 10-year Treasury yield is so important, particularly if it starts to get too elevated, that it starts to stress the market out. And we saw this last year as the 10-year Treasury got towards 4.8%. We know the market was in distress, right? The market reacted to it. That's what we'll watch for again.
Rob, you've given us a ton to think about. I really appreciate you walking through all these areas of macro conditions. It was a lot of fun. I hope this isn't the last time we're able to speak, but for now, I will say thank you so much for giving us some time today. We appreciate it.
Thank you. So great to be with you, Dave.
I really enjoyed that conversation with Rob Haworth. We'll definitely look to get him back on the show later this year to catch up on how market conditions have evolved. I should note we recorded this discussion on Thursday, February 12th. The S&P down aggressively, precious metals down aggressively as we're doing the interview. And like a seasoned pro, Rob didn't bat an eye, did a great job just kind of talking through some longer term conditions. And I think that's exactly how you should be thinking of things as a strategist in a noisy market environment. A couple quick follow-up comments based on my conversation with Rob. First off, I hope you caught really important points there about the fat tail situation, the fat tail phenomenon with the markets. And if you didn't really follow that, just to elaborate a little bit more, a normal distribution, right? If you remember your statistics class from college, or whenever, right, it's sort of a bell-shaped curve, right? Sort of the bell curve, where most of the observations are in the middle, and then you have a small percentage of kind of higher movements. In any sort of collection of data, usually you get toward a normal distribution, which is sort of a normal amount of data, where and that's when you talk about like standard deviations. So two standard deviations means 95% of the data is within that part of the curve. And as humans, we tend to think of things in a normal curve. We tend to think of things as a normal distribution or as a bell curve. So we assume that those really seemingly impossible events, those 3, 4, 5 standard deviation events should pretty much never happen, right? Or very, very rarely. In financial data, you usually have what's called the fat tail phenomenon. So unlike a normal distribution where those high standard deviation moves are almost impossibly low probability, the tails are actually wider than normal. So there's a non-zero, there's a meaningful probability. It's not huge, but it's not zero. So 1, 2, 3, 4, 5 standard deviation events just happen a lot more often in the financial markets than our brains would tell us should happen based on our normal distribution. So that fat tail phenomenon means basically big outlier events are going to happen more often. And that's the reality. That's why it's tough to predict the markets. That's why you have to think about risk, because big one-off events seem to happen all the time. Another point, and that was sort of related to that, we talked about sort of the seasonal tendencies, really more of the calendar, the 4-year calendar cycle, where a midterm election year tends to be weaker than average. And I think Rob made some really good points about, look, that's the average, that's the mean of midterm election years. But there have been a lot of fat tail events that have happened in years like 2026. So don't just assume the market's going to be down because it's a post-election year. Recognize that we need to focus on the data. And as a technical analyst, I would wholeheartedly agree. I think too often we think about what should happen based on whatever, the time of year, the year in the 4-year cycle, the 10-year cycle, just because of whatever we think. And what we have to remember is the market doesn't care what you think should happen. We need to focus on market conditions. So despite what the tendencies are probably going to be, despite or regardless of whatever tailwinds or headwinds are happening out there, focus on the evidence. And there, Rob and I are in wholehearted agreement. Really appreciate Rob's comment on the consumer. That came back a number of times as I was asking about current economic data, talking about inflation, talking about Fed policy. He kept coming back to the importance of the consumer, and I think that's the right way to think about it, right? In a service-based economy, consumer confidence matters. What consumers are actually doing, not just what they say they're doing, which is consumer confidence. What are they actually doing? And that's where price action can be most meaningful. And I thought his way of describing that rotation we've observed, really from the third quarter of last year to the first quarter of this year, spot on. Really appreciate his comment at the end about potential risks, and I love asking someone like that. All right, out of all the things that we could be concerned about, where should we focus our attention? And I think recognizing how some changes in inflation data and what the ripple effects that those things could imply, I think well-founded. Great take there from Rob Haworth, and again, really enjoyed him joining us on the show today. I'll look forward to circling back with him later this year. By the way, if you want to learn more about some of the tools and techniques that you can apply in your own investment process to understand market conditions, to gauge how the market is reacting to different economic data, and so much more, our Market Misbehavior Premium memberships could be a great opportunity for you to upgrade your routines in 2026. 3 great benefits to the premium membership. First off, you'll have access to our virtual courses where we teach you all about behavioral finance and technical analysis tools. Second, you'll get all of our member-only reports like our weekly flight plan and our monthly chart review. Finally, you'll have full and immediate access to our member community where you can ask questions and learn from other like-minded investors. All of that can be yours today if you go to marketmisbehavior.com/premium. Don't forget to use the code podcast when you check out for 30% off your first 12 months on any plan. That'll do it for today. By the way, if you have any suggestions on others that we could invite on as guests on the Market Misbehavior podcast, hey, take a moment, drop a comment on our YouTube channel. We'd love to hear from you and would love to consider some new guests at any time. For now, I will say have a great week. Thanks so much for joining us on the show today. And remember, it's always a good time to own good charts.